our next session, Sustainable Finance, Innovation, Partnerships, and Leveraging Resources for Private Sector Sustainability, which is going to share and inform us about the variety of green, social, sustainable, and climate change financial instruments that development banks and financial institutions make available to advance their contribution to the United Nations Sustainable Development Goals, SDGs, by 2030. I would like to invite Mr. Aurélien Vincent, who is a partner at Strategy and, to take the lead for this session.
Thank you. Good morning, good afternoon, everyone. My name is Aurélien Vincent. I'm a partner with Strategy N, which is the strategy consulting arm of PricewaterhouseCoopers, based here in the region. It's my pleasure to facilitate this session. The way we're going to organize this session is we'll start with a speaking note from you, Mr. Amadou Hott. That will be followed by a short presentation on the core topic that we'll be addressing today, which is the investment gaps in sustainable finance across the globe today. Presentation which will be led for about 10-15 minutes by Mr. Fatih Yilmaz from the CAPSAC, which is one of the co-hosts of this event. And this will be then followed by a panel discussion with 4 key executives from different development banks around the world.
Good morning, ladies and gentlemen. It's a great pleasure to be here. I will not be long, a very short keynote. In Africa, today, the financing requirements for our NDC plans are estimated at $277 billion per year, up to 2030. While flow of finance, climate finance, only amount to $30 billion in 2019 and 2020. On top of this, the private sector investment represents less than 15% of climate finance on the continent. This is a general trend in African infrastructure sector, which is mainly funded by the private sector. This is the reality. We talk about billions to trillions, PPPs, but in reality, African governments do a lot using their budget and do a lot also in partnership with the multilateral development banks, such as the Islamic Development Bank or the African Development Bank. We would like to focus on basically increasing drastically what we attract in climate finance in Africa. To do that, partnerships are really key, especially with the private sector. I think the presentation earlier really highlighted some of the key constraints. I'll focus only on 3 of them. First, for me, what's really important, based on experience, are an investment banker, working at the African Development Bank as vice president, and while being in government as Minister of Economy, was really the need to build the capacities of our government. When I was Minister of Economy, the first thing I did was to raise money from a foundation to be able to attract talent in my ministry. Hire about 10 to 15 people from the private sector, helping fast-track the reforms. We made PPP reforms in a record times. We structured PPP transactions, supported private sector, and I believe that capacity in government is extremely important. It can be funded by DFIs or by the philanthropists. Second, something that is also important is to make sure that we are working with local project developers. Often we have international developers coming into our member countries, but building, let's say, local developers that have skills, that have let's say, opportunities, but that do not have resources, support them with resources, but also work with some competent developers who have money, such as sovereign wealth funds or strategic investment funds. In Senegal, for example, we had the sovereign wealth fund, which I started in 2013. We developed major renewable energy projects with the private sector because we were able to really play the honest broker role between the private sector and government. And I think that is really critical for our countries. And third, it is very important to develop projects to mobilize grant resources, concessional money, to support developers, whether they are private developers or state entities developers who are competent. It's important to provide them with grant and blended finance money to develop projects. It costs money to develop PPP projects. It could be up to 5% of the project cost, and you may lose some of that money or all that money if your project doesn't happen. So you need then a third party to provide concessional and grant resource. It could be from donor countries, philanthropists, MDBs, or setting up a vehicle dedicated to that, like we are doing today at the African Development Bank with the Alliance for Green Infrastructure in Africa, which I'm championing with the bank and other partners to mobilize $400 million of blended finance money to co-invest with developers. Instead of a developer putting all its money in one project, we want to co-develop and share the risk with them. And very lastly, in particular in this environment today, interest rates are very high. If you look at LIBOR, a year and a half ago, it was almost zero. Today, it's about 5%, 6 months LIBOR. That affects PPP projects because the private sector window of the bank, of African Development Bank or even ICD or whoever, the rates now are higher. Where you were lending a project at 4% all in or 15%, 5% all in cost, today you're close to 8, 9% all in cost. And if the tariff doesn't change, it's not adjusted, then the project will not get to financial close. And the governments or state entities paying the tariff or the users paying the tariff have suffered from inflation. What does it mean? We need a lot of blended finance into PPP projects if we want them to achieve financial close faster. Thank you very much.
Thank you. Please, I welcome now Fatih Yilmaz from CAPSAC for the presentation on investment gaps, please.
Thank you very much, Orline, for the intro. Once again, it's a great honor, pleasure, on behalf of CAPSTARC to welcome you all to this panel. CAPSTARC is the co-hosting organization for this panel. So I quickly want to summarize some of the recent outputs projects we have done at the CAPSTARC, which will be actually, can I see the? So the goal of my presentation is to summarize some of the recent research work we have done with researchers at CAPSTARC, which will set the scene for our next panel. We have a lot of esteemed panelists with a lot of background, a lot of practical background, and hopefully we're going to blend this with some of the recent research outputs. So let me start with the macro picture. If you look around the studies out there available to you, you're going to see some big numbers for the needs of the transition to make this a successful transition. So we are looking at roughly $4 to $5 trillion annual for the next 30 years to up to 2050. However, if you look at the investment outlook so far globally, the clean investment levels has not really reached to that number. We've been actually doing quite poorly. The highest number we hit is roughly 1/5 of the actual needs. There's obviously various reasons behind these numbers, and finance comes at the forefront. If you look at the sustainable finance flows out there, the highest number we hit was in the last couple of years, roughly $1.5, $1.8 trillion. Again, referencing the needs 4 to 5 trillion dollars, these figures are still quite low. So with this background, researchers at Capstark, we asked this question: can we actually establish these figures at the country level, so we can probably promote a country level or region level useful policy discussion? So for this, you obviously need a model, and that's what we did. And the model basically focuses on the renewable energy or the electricity sector in the countries. So let me just directly jump into some of the main results of this study. The green bars here you see are the required level of investments into electricity sector that's coming from the model we have. And the yellow bars here are basically the actual investment levels we see in these countries or country groups. And the numbers at the top of the bars are basically how much we need to scale up. So let me help you with reading the figure a little bit. So the first chunk of the figure looks at the developing countries or country groups. This is to say that in sub-Saharan Africa, if you want to catch up the 2050 net zero targets based on the NDCs of these countries, you need to scale up the current investment levels by 15 times. This is only for the electricity sector again. For MENA, the number is roughly 11 times, India 9.5 times, China 1.20 times. And for the developed country group, that's the second chunk of the figure, the numbers are roughly 1.5 to 2.5 times. So the message of the figure is clear. We all are lagging behind significantly on the sustainability agenda. However, what's also important to realize from the picture is the fact that the gaps are strikingly high in especially the developing countries, which tend to be also the regions where the members of the Islamic Development Bank located. So obviously, the next thing that we looked at is the financial distribution of the financial flows. If you look at despite the needs, then the second thing you look at is the financial flows, where financial flows are highly unaligned with the needs. So European markets or the EU 15 simply penetrates. This is the biggest sustainable finance market out there. That's the debt market with the highest size. EU markets or EU countries basically penetrates half of the market. US is getting roughly 30%. So what's remained for the developing countries is really not more than 12% if you exclude China. So on the one side, we have the biggest gaps in developing countries. On the other hand, on the other side, we actually don't see much ESG funds flowing into these countries. So if you dig into the global sustainable finance landscape, you actually tend to see a clear picture. We basically need to scale up. That's an extreme urgency for all of us. Flows, the ESG flows or sustainable finance flows are highly unequally distributed. We have to do something about it. In order to actually contribute to the solution of the first two, we first probably have to start with cleaning up some of the uncertainties surrounding the sustainable finance landscape, starting with the ESG guidelines, definitions, standards, whatnot. So this is my quick presentation on the financing, sustainable finance and investment outlook. The second thing that I want to bring your attention towards is the policy action. Another tool that we developed with researchers at Capstark is a practical policy tool, Circular Carbon Economy Index, which I encourage you all to check the website and utilize and enjoy the visualizations and data analysis we provide. So if you haven't heard of the concept of circular carbon economy, that's here is a 20 seconds background. It became to existence in 2020 during the Saudi G20 presidency and recognized and endorsed by the G20 leaders. So it's basically the idea is moving from linear economy to a circular economy, where you simply reduce, recycle, reuse, and remove carbon. So you basically keep it in the system rather than releasing to the atmosphere. So no additional carbon is generated. So based on this circular carbon economy concept, we created this index. And the index has two components, the performance side, which tackles with the technologies. But for today's discussion, is what's more important is the enabling environments. So we have focus on policies, technology, finance, business environment, etc. So let me quickly show you the results. Here is the distribution of the 64 countries we have in the index. Let me just help you out with reading the picture. Here is the top and bottom 5 performing countries, and here is where the currently ISDB members are located at. I mean, obviously, there's a big distribution. There are quite a bit of gaps across the countries, but what we want to basically provoke with this work is to ask questions: why? Why is this country located at the current place relative to its peers? And that's what I want to bring your attention to as next. I want to focus on the enablers. So among the enablers, the 5 enabling environments, I want to derive your attention to the finance and investment, which is the topic of today. That's the gray bar. So if you look at the figure, gray bar diminishes quite fast from left to right. It simply says clearly that countries are facing with significant gaps in terms of access to sustainable finance and investment. Let me just unpack this quickly. So derive your attention to 3 main things: the circular carbon economy investment, which basically tackles with all sorts of clean energy investments, access to sustainable finance, and carbon pricing, where all these 3 are significantly lacking when you look at across countries. They're basically colors. Take the orange color, for instance, for access to sustainable finance. That diminishes quite fast, where you don't actually even see the color in the second half of the figure. One thing that I want to leave you with is the reaction that I tend to see from colleagues in the industry, where basically when you talk about the low access to sustainable finance of developing countries, the reaction you tend to get is developing countries already have issues with financial access. But in fact, if you look at the financial development indicator, which is the gray bar on the figure, it does not diminish as fast as the orange bars, which is the access to sustainable finance. So developing countries, they do have financial access issues. However, when it comes to traditional finance, access is not as severe as access to sustainable finance, basically. That's what I pointed out. So I've already talked about these 3 points. Access to sustainable finance is particularly limited in developing countries. We need to scale it up. Carbon pricing mechanisms such as carbon markets, which I'm sure that our esteemed panelists will get into, needs to be explored, and transition investment outlook definitely needs to be improved, especially among the developing countries. And here's a quick recap of our website. For the index, you're very welcome to check our data visualizations, analysis, and especially policy simulations for decision makers. Thank you very much for your attention. Looking forward to our productive panel.
Thank you very much, Fatih. Very good. So I think the least we can say is that the call for action is pretty clear. In order to discuss and debate this, I would like to ask to join us on stage first Mr. Rabah Areski from the Harvard University, Mr. Ashik Moeed from the ICD, Ms. Susan Olsen from the Asian Development Bank, as well as Mr. Khalifa Sarh from the Alliance for Green Infrastructure in Africa. Thank you very much to join us. I would like to perhaps start with one quick follow-up question for you, Fatih. One thing that struck me in your presentation was the fact that although until the year 2021 we have seen a pretty exponential growth in actually green and sustainable debt around the world, we see that there is a decrease in 2022. Is that just a glitch for this particular year due to a certain context, perhaps linked to the rise in interest rates and the extension of credit spreads? Or do we have really reasons to be worried about our capacity globally to breach that investment gap that you have very clearly highlighted?
Well, thank you. This is a great question. Well, obviously, with the COVID, we had a better understanding of sustainability, which I think had a lot of impact on investors' appetite. as well as government's attention towards sustainability or sustainable finance and sustainable investments. So during that time, there was a lot of interest among the policymakers as well as the investors in terms of thinking about green dual solutions to our problems, recovering from the COVID as well as recovering from the sustainability issues. So my quick answer to the question, with COVID, there was a lot of interest. However, what happened afterwards, obviously we are in the post-COVID era, we have issues, global political issues going on, as well as inflationary pressure that actually negatively affected the interest or the appetite of the investors. However, this is, I suppose, is not a short-term impact or short-term reaction. I suppose this will stay with us. I mean, the greater appetite for sustainable investment projects, and hopefully we'll see a bounce back quickly.
Okay, very good. Thank you, Fatih. My next question would be for you, Ashik. You are, as part of the ICD, involved day in, day out in sustainable debt and green debt. And when we speak with investment managers, asset managers around ESG topics or green topics, most of them are saying, we have enough money. What we're missing is the right projects to invest in. So my question for you is, what is the root cause of that problem? Is that a supply issue? Is that a demand issue? Or is it both in the same time? Perhaps you have the mic. Very good.
Thanks for that question. So it's a little bit of both, and the reason I say so is because if you see it from a purely private lending, private investment standpoint, there is a supply issue. Then the issue is really supply. There are, for bankable projects, there is sufficient financing available, both debt and equity. And when I say bankable, it's not just a micro level, it also involves the macroeconomic situations as well, involving that country and so on, right? But project readiness, preparedness, these are very, very demanding and quite expensive, something I think in the initial speech, that was also mentioned. For the, on the demand side, what I'll say is that there is a lot of, on the other hand, when it comes to public sector funding, I think there is a lot of gap in the developing countries because essentially there isn't a lot of capacity, fiscal space, money available to prepare the projects properly, to develop the coordination amongst different stakeholders and ministries and SOEs and Ministry of Finance as well as the line ministries. So as far as the preparation leg is concerned, there is a gap of funding. As far as the bankable projects are concerned, generally speaking, funding, one should be able to mobilize funding. Of course, then you have this overarching macro issues like, a lot of countries got downgraded, just to give you an example. Stability issues are there, supply chain, inflation. I think a previous speaker talked about the rising interest rates, yep. And these are realities that creates problem.
Very good. So a multifaceted issue. I would like to turn to you now, Rabah, and perhaps ask you a bit of the same question, but with the perspective of the developing country versus the developed country, because I think, Fatih, that one of the main findings of your research as well is that not only are we missing sustainable investments and financing around the world, but that issue is particularly acute in the developing countries. What is missing? Where are the roadblocks?
Thank you, Aurélien, and thank you to CAPSARC and the Islamic Development Bank for hosting this great panel. I must start by saying that along the line that you just mentioned, there are two global trends, and the battle between these two forces is really going to determine where we land. So the first global force is indeed the formidable decline in the cost of production stemming from renewable. This is a formidable opportunity, including for developing countries. But of course, the other, if you wish, force, which is not so positive, which is a headwind, is indeed the rise in the real interest rate. And this is a global, also a global phenomenon, but particularly affecting low developing countries, which cost of capital is rising at worrisome pace. So we have these two forces, and one is positive. This is this formidable decline in the cost of production from renewable, and the other is more of a negative one, which is the rise in the cost of capital through the real interest rate. But the question is really, these trends hide what we should be really looking at, which is the level, not the trend. And indeed, we have a tendency to hype a lot of this formidable decline in the cost of production. And when we look at a specific case study, if you take the case of Zambia, there was a recent study by the Energy for Growth Hub, shows that the advertised very low tariff from Zambia's scaling power project is actually rooted in a lot of subsidies that stem from development finance. And that's okay. Having a lot of development finance try and boost electricity investment in developing countries is okay. But of course, we need to be more transparent about it. And when we look behind these numbers, this formidable low tariff in Zambia, what we see is that the off-taker, the state-owned utilities, have genuine credit risk and political risk associated. And as a result, subsidies need to counter this very high level of cost of capital. And it is important that we document that and not just go with the try and replicate numbers that are just not there. So, okay to use a lot of development finance. The estimate is that for every dollar of development finance thrown at the electricity project in Zambia, only 30 cents private funding got triggered. So the use of development finance is going to be formidably important. We need to be transparent about it, and we need to prompt convergence. We need reform. We need these developing countries to showcase that, yes, they need the concessional finance, but they also need to reform the state-owned utilities. They need to prove year after year that they are going to require less concessional finance and be reliant on more private finance. So it's a story of, I think, more transparency and more convergence into hard reform that needs to happen so that we eventually only rely on private funding. Thank you all.
And Rabat, just a quick follow-up question on what you're saying, which makes a lot of sense. So pushing the reforms, increasing transparency, increasing the quality of the governance in developing countries. Who is this call for action for? Is this for governments? So have multilaterals also a role to play in this journey?
Yeah. So this is a very important point that you're raising. So there are the MDBs, the development finance institutions, have a critical role to play in being very transparent about how much subsidies they're putting in, how much development finance, how much they're doing on the project preparation, so that private sector actors have much more clarity on what they're getting themselves into. And once we know what works, including as a result of subsidies, there's going to be a lot of price signal that's going to help entice private actors to come in and parse out what they can bring to the table and what they need for this project to be viable.
Very good, thank you. Now I would like to turn to you, Susan, to understand now, to go a little bit more in the specificities of the lessons learned from the different regions around the world. One of the insights as well from your presentation, Fatih, is that the reality is very different depending on where you look in the world. You have an extensive experience of the Asian market. Is there any specific lessons learned from that market that you can draw that could be used in other geographic? I'm thinking about Africa and Khalifa, we're going to talk also about Africa in a minute. Whether in terms of things that have been working well, we've been talking a lot about the power sector, but I know you also have a lot of experience in infrastructure and green transportation. That could be leveraged to better accelerate the breach of that investment gap that we're talking about.
I hope it's working. Okay. Well, thank you very much, and very happy to be here. I want to start with what's similar, actually, because a lot of the trends that you highlighted that were presented in the research from CAPSARC are similar to the trends we see in Asia. Some positive directional movement in the development of the sustainable bond markets, sustainable debt markets, also tripling in volume of issuances. ADB actually hosts the Asian Bond Market Initiative, so it's a very important role that we play as a multilateral to build depth in the capital markets locally. And the data that we tracked also show that sustainability-linked, sustainable bonds, green bond issuances have tripled since 2018, from about 70 billion to almost 300 billion over that time frame. And it's 86% private sector and mostly concentrated in energy. So there's some things that are working well when it comes to renewable energy investments. I mean, pricing tariffs are working well, costs have come down, but the grid is still very dirty in Asia, right? Asia has a coal problem. So if we look at our developing member countries across the region, and it's quite a diverse region, so it's hard to speak in trends that are applicable for all our member countries, because China and India would be a very different story from Kazakhstan or Vietnam or the Pacific Islands. But the renewable energy trends are at least positive from a directional signal as well. China's committed to having 25% renewable energy in the grid by 2025. India is committed to having 30% renewable energy by 2030. So the hope is also that when the policy signals are there and the regulatory environment and the tariff environment is working well for energy, that the financing will flow. The base is still very low, however. Green sustainability bonds are about 2% of total issuances in the markets overall. So there's a long way to go. I think what we're tackling also at ADB are the other areas of high carbon emitting sectors. Buildings and transport is where a lot of our effort is going as well. Overall, as a bank, we've set a target of doing 100 billion in climate finance by 2030, but some of that has to come also in developing green buildings, which is very nascent, especially from a regulatory environment. Most of the countries have voluntary building codes, not always mandatory building codes. No incentives being put either for developers to invest in energy efficiency improvements in current existing building stock, and very little guidance given to developers also on green building certifications. A lot is missing there in terms of incentives. I personally would like to see, and this was a topic that was discussed last week also at our annual meeting. It was ADB's annual meeting last week in Seoul. The flagship publication that came out that got heavily discussed during the course of the sessions was about Asia's transition to net zero, and asking member governments also in indirect ways to direct some of the $120 billion that's still going to fossil fuel subsidies to more incentives for some of the other low carbon sectors where investment is needed, like building and transport. I'll stop there, but we can come back to those sectors if time permits.
Very good, thank you, Susan. Still one question on Asia. One of the things that we have observed in the graph that you presented, Fatih, is that the two most populated countries around the world, India and China, have very different behavior or results in terms of investment gap. If I remember well, the gap is around 40% for China, but around 10x when it comes to India. What are the reasons for this? Is it a question of maturity of the market? Is it a question of currency? Is it a question of regulation? What are the roadblocks, and what would it take for India to catch up?
Yeah, China's really an outlier, for sure, I think globally in the region, in terms of volumes and depth of the global bond market and investment in all of the incremental investment in China. 63% has been in renewable energy. India's picking up quickly. I think the sovereign bond that just got issued, the maiden sovereign bond that got issued, I guess, about a month or two ago, is a good also landmark sign for the market. But the local bond markets in India, which is where the depth needs to come, are still very shallow. I think the total corporate bond market in India is only about 500 billion. So it's nowhere near the magnitude that the Chinese bond market would be. And a lot of the green bond issuances that have been coming out of India are actually issued overseas. So it's from a limited handful of sponsors that have the capacity to take dollar debt. As of course, the rupee is not a transferable currency. So the real need in India to continue to build out low carbon investments needs to come from local bond markets, institutional investors. We are working on some of those issues in our work in India. But there's a big gap to bridge when it comes to China. And of course, the currency and depth of the market, I think, are the two primary reasons.
Okay, very good. Thank you. Thank you, Susan. Turning to you now, Khalifa, I think one of the emerging insight of this discussion is that the real bottleneck is the amount of bankable, sustainable projects. We see that countries like India are facing a certain number of challenges that I suppose Africa is also facing. My question to you is, what would it take to increase the pipeline of bankable projects in Africa? What are the specific challenges that you are facing on the continent when it comes to sustainable projects and financing?
Thank you, Aurélien, for this question. I think, first of all, I would like to say we see progress on the ground regarding the delivery of projects on the continent. If you take, for example, the power sector or the renewable energy sector, we have seen a lot of progresses and a lot of appetite. But as you rightfully mentioned, it's not enough yet. For example, of the $277 billion that we need for climate finance up to 2030 in the continent per year, to achieve national determined contribution, we only see 30 billion annually investment, of which 15% is from the private sector. So there's a lot to be done. And I think the main challenges that are preventing this kind of ESG investment, may it be the private capital or green bonds, are first the lack of bankable projects. Because I will say in the session this morning, this money, it finances projects. So if you don't have projects, you cannot finance, you cannot raise money. And the issue is that on the continent, there's a strong lack of bankable projects that the investors kind of like and that are at scale. So first, we need more resources to prepare projects, to develop them up to financial close, so that investors can be comfortable with the risk that they are taking, they can understand the regulatory framework, they can see a viable revenue stream that can reimburse their investment. So development and preparation and development of projects is key, are key and are missing now on the market at scale. The second point is really capacity building for governments to do two things. First of all, to implement the right reforms, the right regulatory framework that make investors comfortable with the countries. So you see, when countries try to do that, you see more interest. For example, in Senegal, in 2013, the portion of renewable energy in the mix was 0%, almost nil. Now it's 33%. Why? Because the government improved the regulatory framework. There's a new PPP framework. There was a clear feed-in tariff scheme that investors were comfortable with, a local sovereign fund that do development work in partnership with international investors. So it gives them confidence that they know what they're doing and they are not concerned about, dividend repatriation, rule of laws, those things that need to be clear for investors to come. The second thing that is important for government in terms of capacity building is to be able to report on these transactions. Because we see a lot of transactions or projects that are, labeled sustainable. But how do we measure them? How do we tell to the market that the money that you gave us last year, we actually invested in this project, and this is how it's sustainable, and this is how it contributes to SDGs, so give us more. So I think, bankability is key, capacity building is key, and lastly, reduce the cost of capital in order to do more. I think that part also is important. I'll stop here, not to be too long.
If I may react to what you're saying, it seems to me that, of course, building a proper ESG framework and having, a deep understanding, a specific understanding of the needs of Africa is key and very specific to sustainable projects. But lots of the other, I would say, challenges that you mentioned, if I'm not mistaken, are not specific to sustainable finance. The cost of debt in Africa is a reality. The under-leverage of the continent as well, if you look at some ratios such as the debt to GDP ratio, you will see that we are around 50% across the continent, where in most of the developed countries this ratio can go anywhere from 100% to sometimes 200%. And the cost of debt is a real burden, right, for government as well as for private sector. So beyond this, what would be the other specific actions that should be taken by governments, potentially in conjunction with multilaterals, which are very well represented in this forum, to increase the volume and the scale of sustainable projects in Africa? And also, by the way, also another question is, would that answer be different by sector? We are talking about power, we should be also talking about infrastructure, transportation. Is there a difference also by sector, both in terms of trends and bankability?
I think if you take, for example, Africa, it all depends on where you are in the world, right? If you take developed countries, maybe there are issues that Africa is facing now that they already resolved. If you take our needs in terms of development, most of them are really related to sustainable investment. And the point also is, Africa has a unique opportunity, a unique position on the market to develop in a sustainable manner. So all the investment, when we think investment, we think sustainable. And the points that I mentioned are, for me, yes, applicable to investment in general, but they are more suitable for sustainable investment. Let's take, for example, the case of capacity building and the issue of reporting. For me, there's a strong lack on the market, in Africa space, to be able to, really report on the sustainability part of projects that they are funding. And the social and, the social and green impact of those projects. You see, for example, when we talk about agriculture, we do a lot of investment in agriculture. And we kind of label it sustainable, right? Just because we're increasing food production. But we also know that agriculture is a big producer of gas emission, right? So what's the balance? And this is where reporting is important, to understand, okay, true, you are putting money in food security, but what additional investment are you making to make this agriculture green? Are you increasing the yield by technology, right? Or are you increasing your production just by expanding land and using more fertilizers, more water, etc.? So reporting is key. And as of bankability as well, I think it's easier today on the market to go and just do an HFO or gas power plant in Africa, right? Because people are used to it now. But it's more difficult to crowd partners and bring their capital into geothermal, into a vast solar projects, right? So there, bringing resources for development of those projects that is risky and that is not attractive yet for all partners is extremely important. Now, are there differences between sectors? Of course, yes, because even if you take climate, you say mitigation, adaptation, loss and damage, right? Mitigation is easy to fund from the private sector. So if you take, for example, renewable energy, it's easy to bring investors there because there is a clear revenue stream. But if you think about water and sanitation, it's probably public money or sovereign loans. You don't see much private sector there. So there's a difference. I think the approach depends on the sector, where you can identify viable projects that you can do, that the private sector can do, where you can do public-private partnership with a contribution of the government as subsidies, for example, and sectors where for now the government needs to go to the market, take sustainability-linked bond, for example, and finance it. But we need to be careful because with the current high interest rate, we cannot keep doing that much. So we need more concessional fundings from developed countries. We need, for example, more resources from the IMF with the special drawing rights, things like that that can enable us to reach SDGs in a faster manner while limiting the cost of debt. Thank you.
Thank you, Khalifa. So it seems to me from this discussion that the solution scope seems pretty clear around accelerating PPPs, increasing transparency and governance practices, increasing bankability of projects. And the second point is, as we've mentioned through your presentation, the call for action is probably clearer than ever before. However, the current context is not easy. Liquidity is drying up around the world. Interest rates are rising. The cost of debt is rising not only in developing countries, but across the board. Perhaps my first question for you, Ashik, would be, in that context, if we turn into the core topic of this session, which is the financial products, what is it that we could do more? How could we be perhaps more creative going forward to address some of these challenges and manage to accelerate the financing of sustainable projects around the world?
Look, on that, what else? The way I see it is that on a project, especially if you're crowding in private capital, I mean, somebody will need to eventually pay for that. So that whole fiscal planning, because private investors sooner or later will need to get their capital sort of recovered with economic profit. So whether it can be supported from fiscal budget of the government, whether it can be passed on to the end users, or whether it's something that is exportable and you can recover it from the global markets by exporting. So one of the interesting things happening in a lot of our member countries, take the example of Morocco, take the example of Egypt, a lot of capital and excitement is being built because energy can potentially be exported to Europe, for example, not just by transmission lines, but also with the technology evolution in green hydrogen and green ammonia. So a lot of those interesting developments are coming up. A lot of the other ESG you mentioned about transport, the EVs, for example, on the motor vehicle sector. So those things are coming along. Significant investments are being considered, also in GCC. So a lot of those areas create tremendous amount of opportunities and solutions. But really going to the more developing countries and where there is a lot of lag, what I would say is one of the big deterrents over and above what's been already discussed in terms of policy, bankability of project preparation, etc. One big thing for private capital inflow is really the perception of country risk, comfort on whether hard currency eventually will be repatriable, convertible, remittable at a point in time when the capital is supposed to go out. So those are the kinds of issues, I think, where the finance world needs to be more innovative. I think the whole whole gamut of country risk insurance. A lot of expansion is needed on that. A lot of innovative financing is needed on that. Not necessarily direct funding, but essentially the risk insurance part of that to really usher in a lot more private capital. So that piece is extremely important. The other thing I'll mention is, in a lot of these countries, it's also not easy to just pass things on to the end users. There is a payment capacity issues depending on where you're sitting on the curve of per capita GDP. To make it more exportable, because especially for renewable energy, a lot of the resources sit in parts of the world where you do not necessarily have a lot of ready demand or purchasing power. So how do we get those electrons to places where people have a lot of demand and have the affordability to be able to pay, and that kind of increases the economic welfare as well. So that's why I say that a lot of the innovations will also need to take place at public sector, yes, because the whole transmission distribution umbrella, especially transmission, is pretty much public sector as of now, especially in our member countries. But on the so again, there's a lot of activities that are going to come for sure, but then again, a lot of member countries have taken fantastic steps. Egypt, Morocco, UAE, Saudi Arabia. You have NEOM coming up as a sustainable city. So I think a lot of these very good initiatives. Uzbekistan in Central Asia has been attracting a tremendous amount of investments. They've got steep target of 30% renewable energy in the grid by 2030. So a lot of upward swings are going. Look, I mean, the generation cost no longer, once the project is bankable as an investor, once somebody's sure that the externalities are managed, whoever is supposed to pay can pay. When you go and try to convert local currency to foreign currency, you can do that. Rest of it is relatively straightforward now. Technology is tried, tested. The bankability model is well tried, tested. So those are. Last point that I'll mention is also one size definitely does not fit all. And you need local champions as well in different countries. Take the example of ITCOL in Bangladesh. It's a really granular solar homes program, millions of homes being reached out. And you've got different investor-lender groups playing a completely different roles, like the big DFIs and donors pumping in money to ITCOL, who are in turn transferring it to partner organizations, essentially microfinance agencies. And then they're managing granular level individual households, millions of them, giving microfinance loan to put the first electricity supply at home and small businesses. So different models work.
Suzanne, you wanted to react?
Thoughts to what do we need to do more creatively, I think, in the current environment. And I would agree with Mr. Hott that money will flow to mitigation, especially if we fix one issue better that we haven't addressed yet in the discussion, which is the carbon market, right? Carbon pricing. The price signals are not being sent where they should be sent until that part of the equation gets fixed, because it could help a lot to force companies and force operators to bear the full price of their carbon emissions and incentivize more investment in decarbonization. So I would say the mitigation is a lot easier to solve than some of the other issues. Certainly in the current interest rate environment, it's not necessarily creative, but it's just a directional decision to shift more of our private sector investments at ADB into equity, because the debt service modeling is undergoing a real stress test, right, when it comes to the bankability of projects. So one way we can contribute to that in the meantime is shifting more of our investment towards equity. And we've certainly done that for adaptation projects, because again, these are projects that bear a lot of costs that don't have a clear revenue stream. And to the extent that we want to balance out our climate investments as equally as possible between mitigation and adaptation, we're having to use more equity investments in the adaptation projects and also a lot more blended finance to help, force the company reducing deforestation through some of the forest investments that we're making. We're paying for coastal resilience investments in some of our small island developing member states to ensure that kind of conservation. So creativity through equity and blended finance. And then I guess the third thing is, and I alluded to it earlier, this need for local currency in the local capital markets, right? Because once you price in currency risk, it's one thing to bear the interest rate risk, but once you price in currency risk and the price of swaps, many projects become unviable. So that can only be addressed by continuing to work on local currency, debt market, and loan financing.
Thank you, Suzanne. So increasing the price of carbon, initiating at-scale projects that will build the excitement of the investment community. And the example you gave, Ashik, on generating power in Egypt to be transmitted to Europe is one of those examples of game-changer initiatives. Now, we all know that this is obviously not easy to do, considering the heavy amount of intergovernmental alignment that needs to be done, especially in this context globally of increasing geopolitical tension. That is not something that we will probably see a lot of examples of. My question for you, Rabat, is that enough? Don't we need a complete change in paradigm when we see the scale of these investment gaps that we see here? We're missing $3 trillion, right, talking under control fatigue, which is 4 times the current amount of investment approximately.
No, I agree. Focusing on this big number gets us a bit dizzy, and I think we need to break down the problem in pieces. So when you call us to be thinking creatively about the problem, I think two thoughts come to mind. First of all is we've got to turn that crisis, which is essentially a debt crisis for many low-income countries, to an opportunity. The sovereign, state-owned utility needs absolutely to do the reform, and that's going to help with the cost of reducing the cost of capital. So that, I think we need to be very clear about this. A lot of first-generation reform were not didn't take place in many countries. So it's not because we use the term sustainability that things are going to be, the underlying asset is going to be any different. Even so, investors have some more preference for those. And the second is sovereign cannot be the sole conduit of this finance. And ICD and others are exploring the use of trying to do a lot more mini-grids. So this would be more palatable to a private sector that is not as developed as it should be, or as it is in larger emerging market or advanced economy. So trying to tailor both the type of project and the financing, social impact investing, would be, I think, a way to try and put a bit of competition between the sovereign, which is traditionally the only party we tend to resort to solve this issue, together with foreign private sector, but bring in the domestic private sector, be small as it is, with smaller project, mini-grid project that they could play a part in, and that would also benefit a lot of the rural areas which are off the grid. And of course, tailoring the finance, and I think social impact investing is certainly, I think, has a lot of potentiality in low-income countries.
Very good. Thank you, Rabat. I think we still have just a few minutes. I wanted to ask the audience if there is any question, perhaps for one or several of our panelists. Sure, please.
My name is Riaz Sangani. I'm from Sri Lanka. I'm an entrepreneur involved in renewable energy. We were talking about bringing investment into Africa for renewable energy. So I just want to share a experience I had. I was a beneficiary of the Get Fit program, which was conducted in Uganda. And I think it worked out very well, because now they have oversupply of power in Uganda. So my comment is that maybe there's an example from which we can replicate in other countries, and it had a financial benefit, but more than that, I think the other benefit brought was that on behalf of the private sector, it negotiated the agreements with the government. They created a standard power purchase agreement, they created a standard implementation agreement, and I think that was very useful because we, as private sector, when we go and discuss with the bureaucrats, sometimes it's very difficult, and when you try to make a point, you might get victimized also. But if you have a middleman who's strong and who can then look at both sides and create some sort of agreement which is favorable for both parties, it can help to move projects. So I'm just trying to share that experience, and I think the Get Free program went to Zambia, but somehow it got stuck there, and they were going to do in Mozambique. So I think KFW has been spreading it, so maybe ISDB also can join in and try to facilitate that sort of a thing like that, where they come in between the private sector and the government and the utility and create a common ground where both parties can get together and work. Thanks.
Thank you. I'm sorry because there's been a bit of an echo in the room. Anyone willing to react to the comments here? Or you also suffered from the echo? Okay, sorry, thank you for your intervention. I think there is a second question. Sorry? Oh, please, Khalifa, go ahead.
I kind of suffered from the echo, but what I got from the comment is more for a call to have maybe standardized process with the support of MDBs and stuff like that, because once things are standardized, then it's easier for investors to come in. And I just wanted to comment there to say, for example, initiatives such as King Solar that my colleague was mentioning are instruments that we should use more to be able to attract more investment into sustainable projects. So the thing is, you standardize the process with all investors, you develop the project, and then you call for the market to bring the best terms of financing that you have. So, and then it's easier once you have a standardized PPP contract with standardized process, everything ready, just to get money for those projects. So standardization, I think, is very important in the process of attracting more sustainable financing.
And when you talk about standardization, I imagine that you talk about global standardization at a global level, right?
Yeah, of course, a global standardization, having, MDBs working more and more together. Like if you take, for example, each of the MDB that are more and more focusing on climate finance and sustainable finance, they all have private sector arm. For example, the World Bank has IFC, International Finance Corporation. The Islamic Development Bank Group has ICD, which is doing a great job. I'm a bit biased because I was in their board. So, and also you have the AFDB with Africa 50 as its private arm. So all of them should work together in a standardized manner so that the market can easily tap into the resources and do things faster. So that's my point. And yes, global standardization of process and potentially of documentation, even if it's ambitious.
Thank you. Thank you. Please, Ashik.
Scaling solar from IFC, which was really an effort to standardize, and it's been quite successful. Also, in a lot of markets, where we've seen is that the standardization really becomes the precedent project document. So somewhere along the line, the first project happened, and that kind of set the standard. Sometimes it happens so that this first set was not really developed through a very, very structured process. So maybe it was supplier driven. But either way, once you have the first set of document, then it becomes a question of improving the document unless it's already in a fairly, win-win, equitable, acceptable form. So in a lot of countries, we've seen that. Then on the other hand, in terms of process, places like Turkey, where you've had very, very successful programs like YEGDEM, I think some of those, and with a lot of capacity with the local banks to really go along with that, there's been a lot of success under those in terms of the number of projects that took place, the entry of capital, and implementation of those projects. So yeah, standardization certainly helps, especially on the process part, but in a lot of cases, they kind of organically develop, which is the longer route, I would say.
Thank you, Ashik. I think we had another question from the audience. Please, sir. Is there a mic for Mr.
My name is Anahit Krima. I'm from Bangladesh. Recently, for the economic crisis, some developing economies have to shrinkage their financing in the private sectors because the governments, especially the developing governments, have to borrow from the banking nets in locally and internationally. In a case, what is the remedies to speed up the financing in the private sectors? Susan.
So, can you please repeat the very last sentence? So your question is, what should be the role of the private sector when it comes to financing, right?
Financing, to increase the private sector financing.
Versus the public.
For the crisis moment, many developing economies have to be borrowed from the banking nets. So the private sector financing is shrinking. It is decreasing. So in a situation, how to phase out this problem for the increasing of the private sector financing.
Okay, so what should be the role of the public sector to kind of overtake or compensate for the limitations of the private sector in the current context? Okay. Anyone wants to take that question? Please, Rabah.
If I understood the question correctly, I think this speaks to the importance of the domestic financial sector to help support private sector actors and not only support the government. In many developing countries, indeed, banks are geared toward financing the public sector as opposed to the private sector. So there's a bit of financial repression going on. So I do agree with you that the instrument that the financial sector, the domestic financial sector, should be tailored more to the private sector. So we discussed earlier the importance of developing the type of instruments, for instance, currency swaps or things that do indeed trigger a lot more interest on the part of the private sector, foreign and domestic. So I think this has to do with the notion that the reform that would catalyze private sector financing are not only the ones that are sectoral in nature. So in the financial sector reform, hoping that the banking system looks beyond financing the sovereign, enlarge the type of instrument that would help the private sector, I think is a key question and speak to a very pervasive issue in developing countries where the banking sector doesn't support private sector development and is very much geared into very low risk public sector financing or say import finance. So trying to find ways in which we can shift that is really important as any targeted reform in the electricity sector. Hope this helps.
Thank you, Rabah. Any last question from the audience? Yes, please.
Thank you very much. My question will be directed to Dr. Rabah Rizqi. So, Jamal, my name is Jamal Grib, Director for Economic Development, Integration and Trade at the African Union Commission, having the chance to work, of course, at IDB, and the chance to work with, within ISEC, so the insurance arm of the IDB group. My question is very simple. Well, taking into account all those elements that you just tabled now, first of all, the risk perception, the cost of funding, the availability of affordable really financing now globally, and trying really to channel those funds to really bankable projects. I have not really heard anything related to what the insurance, what we call credit and investment insurance, toward really to bankable project. How to make this de-risking really playing that role. How to de-risk really the investment toward, especially in Africa. I'll start really by talking about Africa. The G20 has mentioned the issue of really reluctancy of the private sector to be on board for funding, especially when it comes to the long tenor. The issue of the private sector is looking for really for short and medium, not long. Concessional loan is very important. So we know that from now, the private sector are not really very excited to be there. So for many reasons, of course, the risk perception, the rating issue. There is a really big issue now in terms of downgrading, which is a mix. So from one side, the cost has increased because of the interest. From the other side, it's downgrading some of the countries, which really make the... So for me, taking all this, how can we bring really the insurance and the reinsurance to be part of this de-risking? And how can we really bring the MDBs to talk? Because the MDBs from one side, they are the financier, but from the other side, we have the insurance providers. They do not talk to each other sometimes. They talk more the commercial, talk with but the MDBs themselves, they talk, but they have their arm like MIGA, like ISEC, like DAMA, but still it's very, very, really very low in terms really of commitment. So thanks.
Okay, thank you. So perhaps as your question, sir, is also targeted to Africa, Khalifa, you might perhaps comment. So I guess the question is more around how to further de-risk project and how can we basically decrease the cost of funding. I suppose that there is an intrinsic amount of risk that is related to the country risk, which is related to the rating of the country, that is very difficult to address apart from a more holistic solution that would address the entire risk profile of the country. However, I suppose it is fair to say that there is also a perceived risk in Africa that could be addressed partially through some of the solutions that you suggested, such as the standardization of the PPP processes and how to look at every risk dimension and how to specifically de-risk each of them. Would you have any further comment on what would be the techniques in project finance and potentially further, or by leveraging the support of the multilaterals to address that specific risk?
Yeah, thank you. Thank you for the question. I think there are two parts in the question, right? And I just want to raise one issue, but I want to debate on it. It's the question of risk perception. There's the actual risk and the perception of risk. And in Africa, we suffer a lot from the risk perception. We have many examples. Like if you take, for example, Botswana and Italy, they're both like BBB rated. And if you look at their spread as of today, it's like 300 or 400 bips difference in their spread, which doesn't make sense. At least the fact that they are both BBB rated should lead to similar spread in their bonds. So the perception of risk is a big issue, but we're not going to talk about it. We were going to focus on, how to reduce the perceived risk. Right? So standardization is one, governance is critical with the right reforms to ensure, rule of laws, to ensure revenue repatriation, etc. And one other thing also is the insurance, as you mentioned, right? For example, in the Islamic Development Bank, you have the ISEC group that is providing risk insurance. In the African Development Bank, we also provide partial risk guarantee and also political risk insurance. Meaning that us, as institutions with AAA rating, we are providing our credit rating, our credibility to the countries for them to borrow at good terms, as if almost we were borrowing. So we tell to investors, if, for example, Senegal defaults on this project finance, for example, on the PPA contract, come to us first before going to Senegal. So you are taking a risk on us. And I think what is important is to have more and more instruments like that provide liquidity, additional liquidity to the market, that de-risk projects, but we also should bring more private insurers. We should not just do it as MDBs. We need the rights market to join us in this common effort. We need to have a framework that enables us to syndicate this kind of risk to the market, because ultimately, for example, the default on the continent is in project finance is limited. Yes. It's just a matter of perception of risk, but as we are perceived like that, we need to prove the contrary. And this kind of instrument could work on top of standardization, reforms, and so on and so forth.
Thank you, Khalifa. I'm told that we're running out of time very soon. Perhaps I will leave the space for a very last question, if someone has a short one to ask. Please, if you could please articulate loudly in the mic because of the echo, please, that would be appreciated. Thank you.
Thank you, Mohammed Usman. I'm working for Arab Authority for Agricultural Investment and Development. My question, we have experience in financing small farmers, and I think it is a very good experience, and it shows that the small farmers has the ability to settle all the commitments on due time, and now we are looking for expansion of this experience. I just want to know your advice to IIID on how we can raise funds to establish a 200 million fund devoted to small farmers. Thank you.
Anyone wants to take this question?
So I'm not 100% sure if I fully captured the question because of the echo, but it seemed like you mentioned that financing smaller firms.
Smaller projects. Yes.
So look, on that, what I feel is these projects are very, very important. And in a lot of cases, they will need to be small units. You can't really always have mega projects. It's just not viable, and a lot of countries have done very well. I think one of the members of the audience mentioned about the Get Fit program in Uganda. You've got smaller projects also in places like Sri Lanka in electricity sector that does very, very well. But the real issue on those is that you need to have local champions, really, good infrastructure-focused lending institutions who are locally domiciled, are able to handle those. One needs to have specific programs supported by donors and public sector with the local banks to enable and open up those sectors. Because for multilateral banks to go and try to do those, that model will not be efficient. It may be possible, but it will be a very inefficient model. So those projects are very important. Local partners are needed, and then those local partners in turn gets funded by the state as well as multilaterals and other investors. So that's the model which has worked quite well in a number of countries.
Thank you, Ashik. So, ladies and gentlemen, I think we have, thanks to the research done by CAPSARC, clearly established the call for action. We have also discussed a number of solutions to address that massive challenge ahead of all of us, starting from infrastructure reforms that are needed across the globe, in particular in the developing countries, whether it's in terms of governance, in terms of financial systems, in terms of public sector support. We have also established the need to increase the PPPs, to standardize the practices, and to increase the capabilities in PPPs around the world, as well as to establish a change in paradigm, I would say, almost in terms of creativity on how to innovate when it comes to financial solutions. And the example that you gave, for instance, on how to address the need for the smaller project through some of the more innovative solutions like crowdfunding, for instance, is part of the equation. I want to thank you all very much for your contribution. Thank you to the audience. It was a pleasure. Thank you.
Thank you, everyone, for being part of this session. It was very interesting. Now we will take a between the public and private sectors towards a sustainable partnership. Please be here before 2 in order to start on time. Thank you. So we will reconvene at 5 minutes to 2. Thank you.